Hi, welcome to Financial Fridays. Today, in Understanding Financial Statements, for part 3, we are going to talk about the cash flow statement. But before we jump into the cash flow statement, we need to understand an accounting principle of accrual. What is accrual? In accounting, the recording of transactions is done with the mindset of being conservative. Hence, when you record your income, you try to spread it over a duration and you try to match the expenses that would be associated to those revenue streams. Even though your invoice from the vendor has not come through yet, or even though you haven't yet collected cash from the customers for that revenue. What happens is your income statement does not necessarily give you a clear indication of what was the cash movement for your business. And every entrepreneur should know that what matters is free cash flow. The cash flow statement is basically unraveling your income statement and your balance sheet to understand what was the movement of the cash during a specific period, be it for a week, a month, or a year. To begin with, we have what we call the cash flow from operating activities. In order to achieve this, you start with the net income and you add and deduct items such as payables, receivables, amortization, depreciation. These are items that had an impact on the income statement, but not necessarily an actual cash expense or a receipt. As a part of the cash flow statement, you have what we call a cash from investing activities. This refers to any loans that you may have received, or any capital injections that you may have received, or any dividends that you may have withdrawn, either adding the cash to the business or reducing it. The second part of a cash flow statement is cash flow from investing activities. This refers to any cash movements that happened due to purchase or sale of properties, plants, and basically any long-term fixed assets. The third component of a cash flow statement is cash flow from financing activities. Now, this refers to either taking or paying of any debt, any capital injections, or any withdrawal of profits or dividends from the business. When you look at the cash flow statement, you're basically looking at what was the cash at the beginning of the period, what was the change caused by the operating activities, what was the change caused by the investing activities, and what was the change caused by the financing activities, giving you at the bottom the ending cash amount at the end of that period.